everybody. Welcome to Friday, another Talk Money with Tom show today. We're really excited, actually. Today's kind of a cool day. We got a new all-time high happening for the market today, which is going to be great. Our show here is designed to help people understand, some of the key issues that happen in retirement, especially around the areas of finance, right? So retirement planning, the asset management, and of course, tax planning. And so we do this show live, and we try to answer questions. So you can send those in live, and we'll try to answer them, right here on the air. Again, it's Talk Money with Tom, or Ask Tom at Talk Money with Tom is the email address if you want to send an email, or you can just put it into chat if you'd like. Be happy to answer any of those questions as they come up. You can send those questions in during the week too, and give us a chance to take a look at them. Obviously, the channel itself was designed with education in mind. We're trying to help our clients and others, understand these three areas. And so if you want to go on the channel, there's over 1,200 videos there now, and you can look at, what we've got there. You can subscribe to the channel. You can hit the bell button and, get notified when we put new things in. And another way to get educated is just to talk to us if you'd like. And so you can set up a 30-minute time. There's a book appointment button on our website. There's a link to our website here on the channel. It looks just like it looks here, a little yellow box. And so you go up there, hit that button, and you'll be able to see our schedule live and schedule a 30-minute, phone, in-office appointment, video, whatever works for you, with Ethan and I, and we'll sit down and answer your questions, see what we might be able to help you with. So anyway, that's how it goes. Really fun show altogether. We're looking forward to today's show also. So I do like to start off every show with a summary of kind of what I saw happening this week in the market. So we'll start with that, switch over to this chart. All right, Ethan, so we've been looking at this chart. We really started this chart at the very beginning of 2022,
Yep.
right? And we've been watching this thing, came all the way down, and it's pretty volatile. The very beginning of that chart that's a lot smoother is 2021.
Mm-hmm.
That was an incredible year, actually. I think there was, up until the very end, there was no 5% drops in there. It kind of went straight up, but hasn't been true since then. We hit that top. And so what's different about today?
Oh, look, we finally broke that top.
We finally did. We've been talking about this for over a month now about, breaking through to a new all-time high. Last Friday, we actually broke into the all-time high, during the day, but we didn't close there.
Yeah.
Right. So today, that's what they call the intraday, high. Today we broke the intraday high already because we're at 43.38-ish.
Yeah.
And the high was 48.18, give or take. And so, we're 20 points above that. So we already did that. That's in the books. We have to close above 47.97, which very likely to do at this point, with this much motion. And as soon as we broke through, the market did move pretty nicely.
Yeah, it's gone up quite.
Yeah, it's not quite a green shirt day. For those of you who don't know, green shirt means that the market was up more than 1.5% or more for the day. Could get there. Market hasn't closed. We'll see what happens. But it's a kind of the breakout that we were hoping for.
Yeah, it was kind of just bouncing against that resistance for a while, and now today it's finally broken through.
Yeah, and you can see that, where we got close. Just if you look at the chart that's kind of right over Eason's head there, that portion, it was bouncing off of that high. That's what they call resistance, right? So resistance means that there's a bunch of people up there that might have bought at that price that would like to get their money back, right? So it gets back to that price. They start to sell. And if you keep hitting up against it like you're doing, it's a good sign that you're probably going to break through, because every time you go up, you dry up a few more of those sellers, right? And what's cool about now, there is no resistance.
Yeah.
The market's never been here before. The only resistance is just literally overpricing, overstretch, and those types of things. At the moment, we're not as overstretched as we were. From that run from, end of October to really the end of this year, it was so stretched out.
Yeah.
But we spent the last month essentially going sideways, which kind of settled things in a little bit, gives a little bit more room to the upside, so I wouldn't be surprised to see some run here. It is somewhat important to break into a new high, just because on a technical basis, you can get what's kind of a bad looking chart when you have two tops, the double top.
Yep.
Right. And so still need a few days above that to say that we're really, not hitting a double top. You can get these false moves on one day. So, temper our celebration a little bit, but still, I think that that's going to happen. The key is that the Federal Reserve is, seems to be, at least at the moment, done raising rates for a while.
Yeah, they've kind of set expectations that they're waiting until the second half of the year to actually, if they're going to make cuts, make cuts.
Yeah, that's one of the problems the market's having. I mean, to talk about this week, Monday and Tuesday were down this week. Matter of fact, in both cases, they were down a fair amount during the day and then kind of rallied up a little bit at the end. And so, all of a sudden, then by Friday, we're setting a new all-time high, right? And the reason that market was down, I believe, earlier this week was that, the market is expecting a rate cut in March.
Yeah, the market last week was, you know, majority of the people thought there'd be a rate cut, but now that March has shifted, now that it's actually most people are expecting them to hold rates in March.
Yeah, exactly. And so they have a meeting here in January that was always expected to be a hold, in January, no rate increase. And, the next meeting would be March. And so there was this expectation. When I first saw that, it got up to over 80%, I believe, was the high point for that, the likelihood of a rate cut in March. I thought that was kind of wild because rate cuts are usually precipitated by something that kind of makes that happen. And, you need to see some softness somewhere. Back in the 60s and 70s when they had higher inflation for a while, and then they got it under control a little bit, sort of like they started to have labor issues, right? So the job market started to soften up, and so they lowered rates. And of course, then inflation went crazy and really got out of control. But we're not seeing that here. Matter of fact, this week we had one of the lowest first-time unemployment claims that we've seen in quite a while. Retail sales this week came out for December. They were very strong, much better than expected. So, I mean, I don't actually see where this rate decrease is happening. It could be from a deflationary standpoint, right? But we're still not even seeing that. We still have inflation. If you look back again, at the different measures of inflation, you look at the last 6 months and you annualize that out, multiply it times 2, we're pretty much already at the targets if we can do that. And so maybe there's some thought that you want to lower rates or a little bit, so that because you don't want inflation to turn into deflation, right? And the challenge for the Federal Reserve is always the same. The changes that they make, whether they're increasing or decreasing rates, take time to have impact. So by the time you see things deteriorating, you want to, already have done some rate decreases in that particular case. And I think that's what the market's looking at. However, the market has been stuck in this loop since this whole thing started, it seems to me, of this kind of normality. Let's look at the data from the past when they raise rates this much, right? Then the market falls and we have a recession, period. I'll buy into that. I mean, I've seen it enough. I saw it in 2000. I saw it in 2008, and you see these giant things and then something breaks like Lehman Brothers, all these things happen. But of course, the data doesn't include a pandemic. The last pandemic was so far back that the data is not really relevant to what we're dealing with today. And really what's driving this whole thing is the consumer continues to go out and spend money. And right now, one of the things that's really fascinating to me, the job market is strong. There's still over 8 million open jobs, right? There was 11.4.
Yeah, so it's softened some.
It has, but I think it was 8.8 million was the last I saw. That's still, like, if you look historically, that's an amazing number of open jobs. I mean, it's huge. So you've got that going on, but wage growth right now is in the 4 point something range, and inflation is in the 3 point something range. So we're actually getting wage growth that is going faster than the rate of inflation, which is good because we have a big period of time here over the last 18 months where that wasn't true.
Yeah, people are feeling the crunch basically.
Yeah, rightfully so. If inflation is 6, 7, 8, 9%, and you're getting a 4% increase, you're really struggling with that. And so, but that's not true right now either. So that's also supporting the consumer and consumer confidence to go out and spend when they are getting more money and have more buying power, right? So really, really incredible time, actually. Very fascinating to me how all this is played out, and what will happen going forward. So the big conversations this week outside of kind of the retail sales, earnings were very good. Semiconductor companies have gone wild here.
Yeah, this week has been a run. Supermicro, which is a server company, who does basically a lot of data center with AI, they provide a guidance of where they were, or they increased their guidance, their forward guidance, and they're not reporting till I think the 29th this month.
Yep.
But based on just that, increased guidance, they jumped 30% today.
Yeah, and really, there's a lot going on in the AI arena, and it's pretty much starting, it seems to me, in the semiconductor arena, because to really go through these big data sets, it takes a lot of semiconductors,
Yeah.
and that's a big deal. So you got billions of dollars being spent in this area, companies with like Nvidia and what have you, and so what we've been seeing, in my opinion, the last 3 quarters at least, the semiconductor companies are really running during the earnings season,
Yeah.
specifically, and sometimes they don't run as much outside the earnings season. And what that means to me is that the analyst and the Wall Street, view of what's happening there is too conservative for what is that. So they're coming out and eventually reporting, like this, Supermicro reported early, but they're reporting, hey, things are going fantastic, and we're actually going to up our guidance, as far as that goes. And so they're slowly catching on to that, and we're seeing some runs in those particular stocks. There's an ETF called SOXX, or its ticker symbol is SOXX. It's an iShare semiconductor index. Was up a little over 3% yesterday, up a little over 3% today. So that's one of the places that runs. And back in, I think, about May of last year, we saw the same thing with NVIDIA's, reporting of earnings. So we're seeing tech as a whole running here right now. It's definitely been kind of the winner here, at least in the short term. We have a lot of tech in our portfolio right now because of that. We try to ride the waves as long as they're going, as far as they will anyway. And so that's a big arena right now too. I like tech leadership. There's a lot of really sound companies with phenomenal products and great cash flows, and really good profit margins that are out there in that arena, and they pretty much dominate these big indexes, right? I mean, when you really look at who's at the top in size, an awful lot of tech companies fit there. Now, will they continue to be the greatest thing on sliced bread, forever? Not always. Sometimes what was, like you were saying today, what was in the best the last 10 years may not be the best the next 10 years.
Yeah. And it's kind of crazy, but honestly, if you want to see it, you want to see a broadening, right, to other companies. You don't want to just see only a small subset, running.
Yeah, I mean, typically what you would see in a normal market recovery like this is you would see large cap companies doing well. In general, right now, most large cap companies that are in these indexes, they're dominated by tech, right?
Yeah.
And then that would start to spread out to more mid cap, and then eventually you get the big small cap runs. But that's like a 5-year cycle. And so if we say, hey, this cycle started in October of 2022, we're just really, a year and a quarter into it, so to speak. And so it's still, and the reason that is because it's risk, right? So people would look at a Microsoft or an Apple and say, okay, that's a certain amount of risk. I could have my money at the bank, but it's less risk than XYZ company over here that's making something, whatever it is, AI or what have you. But eventually that risk, if you watch what happened in the 2000 upturn, and again, I'm going to mention this again, you got a combination of a pandemic, which is somewhat credited with the Roaring '20s and one of the best 5 years history in the stock market. And then, of course, we got the dot-com arena from 95 to 2000, which is the best 5 years in the history of the stock market. We have both because we have AI, which is looking a lot like dot-com to me, and just in terms of how it works and kind of where that frenzy might end up. So if it plays out the same way, I'm very familiar with the dot-com run. I was here working on that every day, and if it plays out similarly, it'll be the large cap companies first, the Nvidias and what have you. Then it'll start to spread, and by the end, we'll be hearing about all the little companies we've never heard of before that are going public that are AI companies, and then there'll be a big washout, right? I mean, that's the normal cycle.
Yep.
and then you end up with, you know, the winners out of that, the Amazons and what have you. And I remember a story in the 2000 I still think about, that in Detroit in the very early 1900s there was 2,000 car manufacturers.
Yeah.
You know, because that was the .com, right? That at that time, right? It was making cars, and Henry Ford, and the you know, the ability to make mass produce relatively cheap and those type of things. Of course, you had to have the roadways. Right now we have the silicon, right? We have the chips that allow AI to kind of work in these big data sets. So if it plays out that way, you know, you can do really well. It'll float a lot of boats. It'll make the market go up. You've got to be careful at the end. You know, when it starts to get really narrow, because that's what happens in the end. It starts to get narrow again, back into just small little groups of companies. And a lot of, I mean, NVIDIA could be languishing at the end of this, even though they're still selling a lot of chips, because everybody's buying these other areas as far as that goes. We do have Bitcoin, right, this week.
Yeah, you know, Bitcoin ETFs were finally allowed, and you know, that's been on the market now. People are able to buy it.
Right, and so it'll be interesting to see what type of impact that has, because there's only so much money that's out there.
Yeah.
It has to chase different things: bonds, stocks, real estate, and Bitcoin, futures, markets, you know,
Money
currencies,
markets.
money markets, CDs, right? I mean, there's a lot of places money can go, and really, you know, if you're a stock market investor and you're buying the S&P 500. You know, the more money that can be attracted towards the S&P 500, the better. That's why breaking into new high, you know, that's a good thing, right?
Yep.
Kind of like marketing in a way. So anyway, that's what happened this week. A good week in the end. Started off poor, but the data has been good. I would say that, you know, the data is so good that we still need to worry a little bit about inflation, right? Because it still could be coming at us and still could hold up higher for longer, you know, type of thing on the inflationary standpoint. So, you know, those are the things we watch. It did kick back even further, in my opinion, any threat of a recession.
Yeah.
Right? Because you got, you know, such a good retail sales report and other things that just continue to come out as we're heading into the meat of the earnings season here. And I wouldn't be surprised if it isn't pretty good again.
Yeah,
You know?
we can see, I think PCE that comes out probably towards the end of the month will be a good indication of where we are, because PPI and CPI kind of had a conflicting
Yeah. CPI, you know, Consumer Price Index, talked about that last week, wasn't that great, actually. It was up a little bit. I didn't think it was spectacular. If you dig in, it was mostly, you know, shelter and rent and things. So that's a weird part of that index. The PPI, which is the wholesale index for inflation, was actually good, better than expected. So I think the tiebreaker here is going to be PCE.
that come out.
A lot of acronyms, but that's the big one to me. That's the one the Fed's looking at too. That comes out at the very end of the month. Huh?
Yeah, it comes out next Friday actually.
Oh, next Friday, perfect. So we'll talk about that at the next show. Okay, good. So that's what's happening. Thank you for joining us for the summary. Really appreciate it. We'll look forward to again, you know, doing it again next week.
So this question came in during our actual weekly summary.
Yeah.
What are your thoughts on small cap value mutual funds and how they're going to perform for the year?
Small cap value. We had some small cap value that jumped up into our list. You know, we have 180 ETFs. They're all competing to get on into our models and get into the, you know, into the money, so to speak.
Yeah.
So small cap value had a run there that managed to move up into our list, the top part of our list. We basically have a cutoff line, has to be above that line for us to continue to hold it. And, you know, it was, you know, something falls below that line, we're looking towards the top of that list to see what we can find. So small cap value made it into the list, but it got knocked out this week. And so personally, I think in this particular arena, when you're looking at least in the shorter term, if you're looking at the next, you know, 3 to 12 months, I think this AI piece is going to continue to push growth. And there's only so much money. If you're looking long term, small value is always pretty good long term. You know,
Yeah,
like 10 years.
especially since small caps not kind of fell behind.
Right,
I'd
right.
say large
Yeah,
cap.
if you're looking for value, if you're a value player, we are momentum players. That works for us. We tend to do pretty well versus the market, just finding these waves, with the idea being that something in motion continues in motion. The other concept is a value player who's looking for something that's doing terrible, that has a chance to turn around at some point in time. And I do like funds for that, because you go after a small value stock individually, it's a value stock, which means it's undervalued. it could be undervalued for a reason, and it could go out of business. If you go into a basket of hundreds of them, then that's a better way to do it. I don't have a real problem with that concept, but for us right now, and I think in the short term here, I'd be looking more towards growth because I think the the AI concept, the artificial intelligence piece, is the key area. And with Bitcoin running, now, and all these things going in all these other areas, and CDs still paying decent, and actually yields are coming up right now, so that's going to attract some money to bonds. I'm not so sure there'll be enough money out there to really make small value run right now. It would be my thought process. So I think it has some potential, but that's it. We just sold it this week.
Yeah, if you're thinking about it as a long-term play, and looking for like something that's kind of like of a on the cheaper side, yeah, small cap value may be a place area because small cap has kind of underperformed the market as a whole.
And value's underperformed. So the combination is it's the sweet spot if you're looking for a deal, some bargain as far as that goes. So you have to be really patient with that type of investing. It can work fantastically. The problem is you can languish for a long time. And so it depends on your age and what you're doing. So if I have a client who is currently retired, currently taking some money per month out of their account, really tough to have portions of the portfolio that underperform for the next 3 years and then all of a sudden take off and end up with a good return overall, but they're taking money out. If you're in your 20s, 30s, and you're still accumulating, and you've got a long enough time frame, especially dollar cost averaging into something like that, that really makes sense. So it depends on your situation as to where you are as an investor as to what would work best. It's not really what we do, and I've had lots of success on a momentum basis. I find it to be easier. Find the things that are moving, find them at the right times, hold on to them, have an ability to know when to get out of them. All right, what's our next question?
So earlier this week, we've had a lot of Fed governors come out and say they're maintaining rates. What happens to the market if rates are maintained? We've talked about the CME tool multiple times, and the market has been expecting cuts, in the near future.
Yeah, just to recap, the CME tools, the Fed Watch tool, it is the place to go. You can type in CME, Fed Watch tool, and see what they've got in there. It's pretty interesting. We've presented a few times on the show. And what it does is it shows the futures markets and what the bet is for the next rate change, next meeting, actually. And so, at the beginning of the year, the CME tool showed that the market was expecting 6 rate cuts of a quarter point each, right, starting in March. And the Federal Reserve put out their dot plot at the end of the year, said they're going to do 3 rate cuts, basically quarter point. So kind of half. And so the Fed governor's been coming out, over and over and saying, hey, we're not seeing, that many rate cuts that soon, right? Yep. And honestly, I'm not either. I'm not sure why the market feels that's going to happen. And so now we're seeing that back off, right? And I actually talked about that in my daily videos this week, that, it's possible we could see no rate cut for the year, right? Where it just stays.
And there's some fear associated with that because, the Fed has, in the past, held rates too low for too long or, had them high for too long. So it's a bit of a, trying to find that Goldilocks zone, that just right temperature.
Yeah, of course, the problem the Fed has is that it takes time for these changes to hit. So by the time things are falling apart, if they're lowering rates then, it's probably too late. And we're going to end up with more pain than we should. And if you go the other side, inflation was already happening pretty drastically, and they weren't raising rates. And they were calling it transitionary, remember, at the time? It became a bad word. And obviously that didn't turn out to be true. So this is the same Federal Reserve that didn't raise rates fast enough that now could leave them, up too long.
But there's some examples, like in I think, was it 2019, where they were raising rates and they held it and the market kind of came back after that.
Yes.
So, like, they can do it at times, too.
Yeah, exactly. The weird thing is, if they don't change rates for 2024, it means that there's no recession happening, which is good. And it means there's no inflation happening, which is good. It means we're right in the middle of the zone. Now, maybe that creates a problem for 2025 or beyond because they didn't lower rates fast enough. But I don't see that as being a terrible thing either. And where we are right now with rates at around 5.25, 5.5, that's a very reasonable rate.
Mhm.
Because this is the big deal. You got to understand that when rates get too high, the stock market really struggles. If you can go out and get 10% in a 10-year, treasury,
Yep.
why would you buy the stock market, which averages about 11%, right? Right now, 10-year treasuries, what, 4.5-ish? Versus 11, people are going to go to the stock market. That's why we're seeing some
Yeah.
run here. So it can stay here at this level for as long as it wants, as far as I'm concerned. However, it does create some other problems because, one of the reasons we've had an okay recovery, as it turns out, there's several studies done at the end of last year, is because businesses refinanced during the downturn.
Yeah.
And so, they got just like the rest of us did with our mortgages and what have you, right? And so we're not, my mortgage is at 2.75. I'm insulated from the increases. But as new homeowners go out to buy, right, it's a
Mhm.
higher. As businesses need new debt, it's higher. And so it can have a long-term impact, right? And
Yeah.
so that's what the market's going to be looking at. But I think the rate cut deal, to me, what's important is they're not raising rates and we're not seeing inflation jump back up.
Yeah, and the crazy part is, years past, markets have been successful for at those 5% and 5.5% interest rates. You know, it's really when they're kind of raising rates is when we run into issues.
Yeah, and the best 5 years in the history of the stock market from 95 to 2000, I remember 6% Fed rate, in that time frame. They were raising rates. I think they raised rates 19 times actually in that time frame. And eventually they got up so high that it broke everything. And, they irrational exuberance that they were worried about disappeared in a 45% market drop. That in essence is, not happening here, at least at the moment. The
Yeah.
rate. That's why the market has taken off since the end of October, because the rates are not increasing at this point in time, and they can stay there. I think the market does okay. And we'll see what happens to the economy in that environment, but could be fine. This is not a bad rate level to be at. I do think the average long term is around 6%. I can't remember that for sure, but it's right in there. So, being at the average rate increase, the markets have been fantastic for, a long, long, long
Mhm.
time, really, especially over the long term. All right.
You mentioned Bitcoin ETFs earlier this week, how the spot ETFs have come out. What are your thoughts on just Bitcoin ETFs in general?
Well, Charlie Munger with Warren Buffett's partner, he really hated Bitcoin.
He did.
He was really against it, and his points are I think somewhat valid, just in the sense that there's nothing behind it. It is pure speculation, and not that that doesn't exist, right? There's some other things that are out there a little bit like that, but uh, I guess my concern is just it's an allocation of resources as a world and a country,
Hmm.
and a capitalistic system. Ideally, money is being placed into the very best hands, right? So you give your money to Microsoft and Apple, that type of thing, because they are producing products and they're doing a good job at it and they know how to run their businesses.
Yeah, and they're going to create a value, and then because they create this value, their prices increase, and then you make a return on that.
Yeah, so when you put Bitcoin in a version of an ETF, it makes it even easier for money to flow into that
Hmm.
direction, right? And away from stocks, bonds, the banking system, et cetera. And you're basically, the idea behind Bitcoin is that theoretically it has some use, right? But it
Yep.
hasn't transpired to be useful yet, even though it's been around for a while. Maybe it becomes a kind of a quasi currency, and they're probably not going to stop at Bitcoin. It looks like either there'll be some other of the
Yeah, they'll
cryptocurrencies.
probably add other
Yeah.
major coins, but it trades like a currency, and
Mhm.
that's how I think you should view it as.
Yeah.
It's like a speculative investment. I can invest in the U.S. dollar, buying the U.S. dollar, ETF, and my idea is that the U.S. dollar will go up in value, and so it's just kind of like a similar thing with Bitcoin.
Yeah, the problem is the US dollar actually has a value. It's useful, as you can evaluate it with treasury bonds, and there's all kinds of weird things that go on. The thing with Bitcoin that I always kind of struggle with is that it really just requires somebody else to buy it at a higher price. Period. That's how you make money. And for no other reason than they think it's going to go higher, right?
Yeah, with currency, a lot of things is because there's world trade, right?
Right, right, yeah.
Um,
There's an action happening that's creating at least some of the motion of the currency itself. There's a big, it's the closest thing to Bitcoin in terms of speculation goes, but Bitcoin's kind of unique, really, in the way that the speculation works. And so, yeah, I don't have any problem with if somebody told me, hey, I want to buy something for my portfolio, fine, keep it small, we'll try it out, that type of thing. We're not putting it in our portfolios just because, it's got a lot of volatility for one thing too. It does move. And interestingly enough, it ran up before the approval and then it's been running down ever since. Yeah.
Yeah, there's some speculation because it's easier to short that, there's some negative interest being pushed.
Yeah, they can short it now on the hedge funds and what have you, huh? So that's, yeah. I don't have a huge problem with it. But I'd much rather see it not be there in a way, just because I think that it's, allocation to capital in an area that may not be producing as much as an investment into a company as far as that goes, but or even into bonds, which get to be used for something.
Yeah.
So anyway, that's a good question.
What can we expect in the short term if the market closes for a record high? We're above the record high right now. What happens with the close? Does it run for the next couple weeks, or what does it kind of look like after it closes?
Where are we at now?
Let's see. 48.37.
So same kind of when we started the show, getting close to the close here. And so up about 1.2%. So the normal scenario would be that you would actually probably have, in the very short term, a day or two, sometime during next week, a pullback close to the all-time high. That would be the norm. And then again, in the norm would be that now that was resistance, right? We've broken through, it now becomes support.
Yeah.
Because just the opposite, a lot of people had to buy to push it through. And then the thought process is, hey, it went up. I made some money, at least on paper. If it comes back down, I'm going to buy some more. And so then it would bounce off of that. And then you could get a pretty sustained run because there is no resistance above, right? And there's just an excitement that happens and what have you. So I think you're going to see, that would be a normal pattern. I don't know. I study patterns a lot. They don't always work out. I know that enough if you study them, but that would be the norm, pop up maybe another day or two or not, pull back. It is Friday, so I wouldn't be surprised to see Monday come back down and test that high again, because weekends are weird, and the Mondays can be very unusual anyway. And then boom, you get this, kind of motion upward again. But it's a good thing. Historically, the average rate of return after hitting an all-time high, the way that we did it here, is close to 14%, which is, a fair amount higher than the, average rate of return for the market itself. So, you got a lot of between the Zweig breadth indicator thrust that happened in November, November itself, being a huge month at 8.9%, and now, this breaking into an all-time high. All of those have positive 12-month track records thereafter. Some of which are really high, like the Zweig breadth indicator was up, almost 24% over the next 12 months in the 18 times that it's happened. But the historically, when you get into an all-time high like this, 12 months from now, it'll be higher. I think 13 out of the last 14 times this has happened, for example, it's been higher. So maybe it's only 1% or what have you, but still higher. So that bodes well for 2024. Yeah, it's a good question.
What is a margin loan and how does it work? And what are the risks associated with margin loans?
So margin loan is where you have securities in an account and you borrow against those securities. The maximum that you can do, what they call the margin limit, is 50%. So if you have $100,000, you could borrow $50,000 against that $100,000 position. The Great Depression actually had a 90% margin loan allowed, so you could borrow $90,000.
Yeah, it feels like every time someone gets into trouble, they kind of restrict that more and more.
They do, and they use that as a tool to kind of restrict things. And actually, one of the things you can look at to see how much speculation is happening in the markets is to look at how much margin is being used as a whole. So you can borrow against it. You have to pay interest. right? And then the real problem is you're borrowing against this very volatile asset, potentially. You can borrow against, there are different types of loans. You can borrow against a specific security, or you can borrow against your whole account. It depends on the broker dealer and different arrangements. But nonetheless, if that 100,000 drops to a certain level, you can get what's called a margin call,
Yeah.
right? And so margin calls are really kind of a nightmare because basically all of a sudden you don't have enough equity to meet the 50-50 requirement, and they want you to put money into the account. So you got to pull into your pocket, or they will force a liquidation.
Yeah. So let's say you have, your margin, you need $25,000 of like cash to, fix that margin call. Um, if you don't have that money, they'll sell stock. They'll basically sell your positions. And that, if you have positions that are forcibly liquidated, you could have big tax consequences. Because a lot of times when you do these margin loans, it's on an asset you don't want to sell, but you just want to borrow against it. And so, you probably have a stock with a low cost basis and you can't really sell it without incurring a ton of tax. So the idea is use a margin loan against it and you can, get the capital you need without, having to sell any stock.
Yeah, exactly. And the ultra wealthy, these big time multi-billion dollar owners of these big companies will often borrow against their founder's stock instead of selling it. Number one, they don't have the capital gain to pay, because they probably pennies on the dollar. And number two, they don't lose control of the company by selling that stock either.
Yeah, when you get money from a loan, you're not taxed on that money. So that's the real big advantage. When you sell a stock that has capital gains, you're taxed on those gains. So
it allows these guys to go out and do these big yachts or start a different company or what have you without having to sell any of their stock. They just borrow against it, right? And so that's a form of a margin loan as far as that goes too. So it's heavily used in the ultra wealthy arena. It kind of makes some sense, I guess, as long as you keep it pretty small. If you've got $100 billion worth and you borrow $1 billion or $2 billion, that's probably pretty safe. Instead of selling $1 billion or $2 billion and ending up with those big gains and then losing that share of your company too. So I think it makes some sense in that arena. On the average Joe standpoint, it's a pretty speculative arena that we certainly don't do here.
It's expensive. When you compare, I can just talk about Schwab's rates because those are the rates I know. Is they have a base rate and then they kind of have this another one on top of it, and the base rate is just 11.75%, which is way higher than a HELOC if you're trying to qualify for a HELOC or just a regular mortgage. But it's cheaper than a credit card. So if you need money desperately, this is probably better than maxing out your credit cards and not paying it off. But it's an expensive option.
Yeah, hopefully you'd keep it really short term. You needed it for something. You still got to be careful because the market can, even in the short term, can turn down. We've got all kinds of things that can happen at a moment's notice. And I mean, right now the market has huge momentum. It just broke into a new high. You would think, okay, things are great, and they should be great. But we've got situation with Iran and Pakistan right now. We've got, the situation in Israel and Ukraine, and we've got some pieces that are kind of, there. China is struggling with their economy. Who knows what could happen? And something could break that the U.S. can't really fix or bail out. We bailed out last year or fixed the banking, regional banking scenario, and the market kept going. But something could happen. So that's where you got to be really careful with a margin loan. You're actually taking a big risk of a margin call. That can be kind of stressful, to be honest. I wouldn't consider it a first line arena to take a look at for needs. For borrowing personally, and I don't think we have anybody with margin loan right now at all.
It's a pretty uncommon thing to use in a normal.
Yeah, exactly. It's much more common in the arena of speculation. That's where you're kind of. Matter of fact, at one point in time, I read an article about some of the cryptocurrencies and some of these exchanges, which would allow basically a 99% margin essentially. So you buy $100 worth for $1.
Yeah, I think this is very similar in currency trading. You're always trade on a leveraged basis. So you're trading on like 50 to 1 or something like that. Right. So you're borrowing against 50 times your capital.
Yeah, and again, nothing wrong with that. It's a whole different world as far as that goes. And I bet you some of those bets that pay off are unbelievable, but I would bet that the average person probably doesn't do spectacularly with that. Even the average professional would struggle in that environment, in my opinion. But yeah, it's a good question. All right, we have time for maybe one more.
So with the new year, is there anything I should think about financially just to start my year off right?
Yeah. Well, there's different things. There's kind of housekeeping things, and then there's the investment side. So I'll talk about the investment side. You can talk about the housekeeping
Okay.
side. So on the investment side, one of the things we always look at is do we have something that's been at least kind of underperforming the market or underperforming our other holdings that we have big gains in for the clients. We might pare back some of that at the beginning of the year and capture some gains, with the hope being that maybe we can capture some losses in different areas during the rest of the year to kind of offset those gains. So I like to do that early so that I have the whole year to kind of do that. We try to capture losses aggressively, actually, and that works quite well. The other thing that I always look at is potential rebalancing the portfolios at the beginning of the year. We have very set models that we're guiding towards. And the IRA type assets, we try to keep them really close to those.
Yep.
And they tend to float away during the year because one part will do so much better than another. And, we believe in diversification. So, we want to rebalance and kind of get that all cleaned up. On the taxable side, the rebalancing is much more difficult. We actually have to go through manually and take a look at that one account at a time, only because if you just let the machine just do a rebalance, you can end up with some massive capital gain. I mean, we have people with 500,000 plus in capital gains in some of these positions. So, that's another thing I would look at is kind of rebalancing, selling some of your, gains that aren't doing as well as they used to. And I think those are the two biggies in the investment side of it.
Yeah, and so for the planning side, a lot of it starts with, is my budget changing this year? Do I need to do I have any big expenses coming up for the year that I should plan for? Another thing is, did I use my emergency fund? Is it large enough still? Am I happy with it? Because there's with life, there's inflation in some sense, and so is your emergency fund keep up with that? Next is revisited goals. Are my goals that I set out last year still accurate, or has my life changed in some sort of way? That's something I think about. Maybe I have a child now. I want to kind of help save for their college. That's a new goal that I didn't have before. If you're still working, checking your contributions. If my goal is to max my 401k, do I have to change my how much I save per month to hit that max still?
Yeah.
And then one of the last goals is kind of less fun is my estate plans and my insurance kind of up to date? Those are kind of like the really boring ones, but it's always good to have those up to date. And so just getting it done at the end of the year, you don't have to worry about for the rest of the year or the next couple of years.
Yeah, I think the other thing we see with a lot of the clients is that they want to know what their required minimum distribution is at the beginning of the year, because the way the required minimum distribution works is the calculation is based off of the value of your IRA or 401k or 403b or what have you, retirement plan, on the last day of last year.
Yeah.
And then, we can do a little calculation and figure it out. I think that just helps with budgeting, what's coming, and because it changes every year. The value of your account changes every year. And then the factor that they use to divide into that value changes every year also. That table comes from the IRS. So that's another thing we see a lot of clients doing. It seems like a smart thing to kind of know, what you have coming, whether you're going to give some away to charity. It'd be nice to know how much you have coming in, or you've got other budget needs, going to do a big trip or travel, or whatever it might be. Kind of helps to know what's coming. So anyway, again, that's only for people that have requirement distributions, but that's something we've seen a lot of here at the beginning of the year. A lot of emails been flying around with that one. So good. That's a great show. So the market's almost closed. Where are we at?
Let's try.
Just curious, see if we can get our all-time high close.
It is at 48.37 still.
48.37. Okay, so it's it's been that same spot all day.
Yeah.
I mean, not all day, all during the whole show. That's great. So that would obviously it's a a new intraday high, which was probably 48.38 or something along those lines, and then. It's well within a new all-time close too. I pay more attention to the close than the intraday. I think it has more importance. So looks like we'll make it. So it's kind of fun. It's been a while. I got a lot of people been hoping for that, so there you go. Good. Well, thank you very much for coming. Again, send in questions. We love it. Gives us a chance to look at them. Send them during the week. Ask Tom at talkmoneywithtom.com. You can send them there. Obviously, you can also, go to our channel, look at the content that we've created. There's a lot of really useful things, I think, there that have helped our clients, could help you also. Even if you are a client, still a good thing to go and learn. Makes it easier for all of us. And then, subscribe, hit the bell button if you want to know what's coming. And of course, book an appointment if you would like. Get, our appointments online, 30 minutes. Come see us or phone call, video, whatever it is, and we'll be happy to meet with you. So thank you so much for coming today. I really enjoyed today's show. Great questions today. So look forward to seeing you again next week.